Hello and welcome to IG's Trading the Markets podcast. I'm Jeremy Naylor. Deep concerns about the new coronavirus outbreak are gripping global markets this week. The Dow's just had its worst 2 days on records. And volatility has been taking hold with a near 50% spike in the VIX in a single session. Interestingly, though, gold is yet to enjoy the fruits of the broad risk-off sentiment. Well, joining us now on the podcast to discuss the coronavirus and its implications for global markets is Paul Robinson, currency strategist at Daily FX. Paul, it's good to talk to you. Let's start with the US major averages first of all. What do you make of some of the sharp declines this week? Is this the start of something more sinister, or do you see this as an opportunity to buy the dips?
Well, I think first of all, the more surprising aspect to this whole situation in the last month is how long it took for global equity markets to really respond, right? Especially the U.S., which has really just been kind of in its own little world, if you will, more focused on the tech earnings and just general easy monetary conditions and whatnot, which have been fueling this whole bull rally. And I think that there was just a big discount as to the full implications of what could happen with the coronavirus, despite no one really having any idea as to how the whole thing could play out. So I think the delay, is also part of what's exasperating this decline, right? Is that all of a sudden everyone realizes that this could be a lot worse than maybe initially anticipated.
If we're looking for a flight to safety trade amid the coronavirus concerns, are there pockets of the equity markets that could outperform, or is it time, do you think, to turn to more traditional safety assets like treasuries and the Japanese yen?
Well, you mentioned the Japanese yen, and that's another one that's been a little interesting. Is that we had that really big pop just last week in dollar yen, where there was a lot of flows out of Japan on fears of just how bad things get there, and then the last few days it's kind of going back to its more traditional correlation, where you have stocks rise, dollar yen rise, vice versa, and obviously with the stocks coming off, we've seen flows into the yen, which you would normally associate with a decline like that. As far as safe havens, I mean, gold is a good place, I think, to be. Just generally speaking, it has been for a while. The trend is up, and while it hasn't exactly rip-roared during this last up leg, I think partly that's because it had already had such an extended run prior to some of the more recent events. But I do think that we might get a little bit of a retracement in gold here near term, as those flows from risky assets to safe havens kind of reverses on perhaps what could become an oversold bounce in equities. But I think overall, longer term, gold is still set up to rise.
What's all this mean, do you think, for the Fed's monetary policy looking out for the rest of this year?
Well, I mean, this certainly isn't a prediction of any sorts, but you do have to wonder, are they going to maybe take some preemptive measures here and perhaps have some emergency measures like a rate cut, or and then additionally some added liquidity to markets? It certainly can't be ruled out, right? Just because given that this is something that's turning out to be, they don't want to sit around and be the ones to look like they did nothing, right? That's kind of one take I think you can take on it with the Fed, and it's not. There's always been this joke in recent years that the third mandate behind labor or full employment and stable inflation is also keeping the stock market propped up. And while someone could cynically say, "Oh, the stock market's declining," the Fed here, they're going to start focusing on their third hidden mandate, if you will. But this time around, it may actually be something that really, there is a real threat here, as opposed to just stocks selling off. It wouldn't surprise me if they don't do something before one of the scheduled meetings.
And to what effect do you think on the US dollar then? Any downward bias to interest rates that may prevail? Is that likely to weaken the dollar, or do we see the dollar as an opportunity to protect one's capital if you've got dollar-denominated assets and the dollar itself?
Well, yeah, that's when it comes to the dollar, it's not so much are things tremendous in the U.S., right? It's just it's kind of a function of when you look around, where are things the least worst, so to speak, right? So, and that's when you're looking at the euro. I mean, it's been kind of a one-way train of negative news, and you look at emerging markets. I mean, obviously they're really being impacted by this whole situation, and of course, even though they have some really nice interest rate differentials, like there's a 7.5% difference between the U.S. dollar and the Mexican peso, there's still it's kind of the safest place to be, right? It's the highest ground for the market to kind of move to. So in regards to, this is one of those situations where if we really get like a really uncertain environment, you could have gold going up, you could have the dollar going up, which has really been the case, right? We've seen that happening over the last year, even where gold is higher, the dollar is higher. So you could effectively, and that's really when you get into an uncertain environment, that correlation where everybody thinks gold goes down and the dollar goes up and vice versa, it really breaks down and they start to just trade together, and that's one sign that you've really got some uncertain stuff going on too.
I know you pay close attention to technical analysis. What kind of level should we be looking for with regard to the dollar, and which particular way of the dollar trade should we be looking to expose ourselves to? Do you use the dollar basket, or do you do a euro-dollar trade? I mean, you've already spoken about the dollar-yen, for an example, but what is it best to trade in these times for the dollar?
Well, the U.S. dollar index, the DXY, is predominantly weighted by the euro. It's about 57% of the index. Interestingly, the euro is just now coming off of a 20-year trend line, and it's very near the gap. 107.24 is the gap from the French election back in April of 2017. And I think that you get down below that 107 level on the euro, and you're going to really see the U.S. dollar index take off. Now, to that end, if there's one place that is one bright spot in currencies versus the dollar, I think it's sterling. I think cable is it's holding well. It's one of the kind of outliers in that things have turned from negative to positive, right? That there's some positive things going on there, and so relatively speaking, sterling seems to be holding up well. But I think generally, the dollar may pull off here a little bit. Like I said, you could get a technical bounce here from that 20-year trend line, the French election gap, in the euro, which is going to push the dollar index down. But I think it's a buying opportunity.
You mentioned the gold and the dollar trade both moving up. Let's move on to gold and take a look at that in the context of what we've seen for the dollar. Why has the precious metal struggled to benefit from the equity sell-off? How much of it is because of what's been happening to the dollar? I read this morning an interesting article from Kitco, which, let's face it, have an interest in the precious metals market. Mm-hmm. They're suggesting something like 2,000 is not impossible for the price of gold. So clearly they see upside. What's your view in the gold price at the moment from where we are, just below the 1,700 level?
Well, when we were running up into early part of January, we had and then we had that what was the Iranian situation. You had a big reversal in gold, and it indicated that the market was it kind of gotten ahead of itself. And I was looking for some sideways congestion, which we got, and I was actually thinking it would last a little longer. But obviously then the coronavirus situation started to brew up. And I mean, not for nothing, but just even looking back from the 5th of this month, it did go from 1550 all the way up to a high of close to 1690 here just a couple of days ago. So, I mean, it did participate in this. I think that sometimes people maybe think that it should have just like blown up, but I would still say that's a pretty healthy move, 6-7%. Now looking, and again, I think it could pull off here. We do get some rebound in the risk trade. It could pull off, but the next really big level that I'm looking at is around 1,800. But the 2,000 call by Kitco, it doesn't. I mean, the all-time high is around what 1920. So I mean, you're really not talking about a long distance from here. Of course, it's not going to happen overnight. It's going to take a little time to do so. But yeah, I certainly think it could make a new all-time high.
Look, Paul, that's all we have time for today. Thanks indeed for joining us. That's my guest today, Paul Robinson, currency strategist at Daily FX in New York. I'm Jeremy Naylor, and make sure you subscribe to our podcast series.